I'm Shiv Gupta, CEO of Sanctum Wealth, and your host for the session. Our discussion today will revolve around this exciting in all sorts of ways asset class. We'll talk about some of the key trends, some of the challenges facing the industry in India, and of course, Arkam Ventures itself, which is a VC firm focused on Middle India. We'll explore that theme a little bit in depth as well. Joining us for this session are stalwart investors Rahul, Chandra, and Bala Srinivasa, our friends. And we've got a colleague, Vishnu Hari, also joining from Arkam Ventures, who's sitting with Bala. Rahul and Bala are founders of Arkam Ventures. They're both published authors, with years and years of experience in the field. And we look forward to chatting with them. A little later, we'll also speak to Madhusudan, who's the CEO of KreditBee, which is a highly successful personal lending platform and also one of Arkam's portfolio companies. The session will last for about 90 minutes, and we'll focus on the topics that we've thought of in advance around the question that our investors typically ask us. However, please feel free to ask questions during the session. Just use the chat feature, preferably directly to me, and we'll try and address as many of them as possible. We'll also set some time at the end for Q&A in case you haven't asked any questions through the session, and you can do so at the end. We really hope you find the session engaging and insightful. Let's start with a quick introduction of our guest. Rahul is, and you can see which one is Rahul, with the label, etc., is one of India's pioneering venture capitalists. He started in 1998 at Walden International's India-focused fund, and then later moved to Silicon Valley to invest in tech startups. In 2005, he co-founded Helion Ventures, which is a quite well-known name domestically, and invested over $100 million in startups, including some that went public. Many of these are quite recognizable names. In 2020, together with Bala, he launched Arkam Ventures. Arkam, I believe, means limitless in Sanskrit, and raised a $106 million fund that invests in companies using technology to create new markets for Middle India consumers. They've invested in several promising startups at Arkam. We hope to hear a little bit more about some of them. These include the likes of Jaikisan, JAR, Smallcase, and KreditBee. And as I mentioned earlier, we'll be meeting the CEO of KreditBee in a little while, Madhu. Apart from his professional pursuits, Rahul enjoys solving crosswords. I hope he's done his daily crossword today, reading history books and learning to breathe consciously. Very excited to have you with us today, Rahul. Thank you for joining.
Thanks, Shiv.
Bala Srinivasa has had a very diverse career in finance and technology. He's worked at Wall Street, initially as an analyst during the first dot-com boom and bust, and later became CXO in 2 global startups. He's also worked as a venture capital investor, of course, which is why he's here, partnering with entrepreneurs to tackle all sorts of problems in India's biggest markets, such as consumer lending, retail investing, and digital financial infrastructure. He was previously a partner at Kalari, another well-known name, and is now, as I mentioned, co-founder and managing director at Arkam Ventures. So really excited to have you with us too, Bala. Thank you for joining.
Thank you, Shiv. Looking forward to it.
Right. So I think let's dive right in to our conversation. Let's start with you, Rahul. Just looking at the overall environment, it's been a pretty tumultuous macroeconomic environment for the last year or so, globally, and I suppose to an extent in India as well. Having said which, there appears to be a consensus that India is finally in a macroeconomic Goldilocks zone, some sort of a sweet spot. What do you make of the economic and business outlook? And what do you think are the near-term and longer-term prospects for startups in this environment?
Sure, thanks. So I'll launch straight in. I think we've been pretty blessed. I think every venture cycle has been a very sharp peak and trough. Venture is a riskier asset class with extremely high alpha compared to most other classes. So as asset prices go up with excess liquidity, venture shows an even sharper increase or decline. It's always a private market. There's very few public references, except for the very late stage private companies which have near comps where growth can be comparable to the public comps, and hence the multiples can also be. But barring that, 99% of most private startups are very dealing to any kind of a public discovery of price. It's always eye of the beholder that's driving that, and more than that, it's the wallet of the beholder that's been driving it in the last few years. There is a much anticipated correction that we are seeing. Everybody was saying this is the longest bull run we've ever seen. Now in hindsight, it makes a lot more sense. The flow of capital has been across multiple countries, not just the US, where excess liquidity was created, and it flowed into markets as diverse as Ghana as it is in India. India, over the last, I would say, 4 years, has emerged as the top 3 destination for venture dollar globally, and it's by far, I guess, a place where expectations from the future is higher than any other place to give returns as well as have the most exciting startups come out from. So while we are in a dismal business environment where a lot of questions are going to be asked about the flow, as well as the real question to ask is what is the right amount of dollars that is needed to sustain the kind of environmental or entrepreneurial hunger that is prevalent in India? What kind of startup volume are we seeing, and what really is happening on the ground? And if you go back to the main thesis of venture, is that a customer's need is what we need to solve here. And the fundamental problem is not oversupply or undersupply of capital, but it is, are there enough problems to be solved? And are there big enough problems to be solved? So India remains a country is got massive tailwinds in terms of what's been happening in terms of digitization, etc. But it's also a country where the need to solve problems with big outcomes as a result will be one of the highest. So, Bala and I are obviously super excited about the next 10 years in India for venture, irrespective of the business environment. The problems that we're seeing can result in so much value creation that we are not at all dismayed by what's happening globally. And it's a long cycle. I mean, we'll talk more about it, but an entrepreneurial journey, as we've seen over the last 2-3 decades, is 7-8 year journey. It's there could be 1 or 2 business cycles that come and go, and you don't even feel anything. But at the end of the day, if the entrepreneurs keep seeing those problems and keep putting their basically life energy into solving those, I think venture folks have a lot to be thankful for, and and also be expectant of, which is a lot of value that can be created from all these problems. So I don't see those going anywhere. So very excited.
Excellent. So, I think the long-term view is certainly clear. We're all proponents. And we'll talk a little bit later about some of these tailwinds, a little bit more in terms of the nature of the connectivity, which is allowing people to capture this opportunity across the pyramid. But just on the near term, just the impact on capital, just a question someone had was that, so we have been in a monetary tightening environment. We know that incremental capital flows have been affected somewhat, but it is also not true that there is quite a lot of dry powder. And so what is happening on the ground with deal making?
The most visible change with a lot of capital flowing through with a lot of investing was deal velocity. And deal velocity was leading to very loosening of the deal terms. Deal velocity was also leading to the, I would say, the arbitrage between a company that has no value. It could be, it's like a painter's art, right? I mean, at the end, if it's an unknown painter, it can make a potential masterpiece, but there's nobody to value it unless there is a benchmark. A startup is like that. Unless somebody goes and values it, there is absolutely, could be zero for all you know. And the arbitrage is that delta, which is, what kind of valuation goes in to begin with, and then what do VCs come in at? That was obviously massively expanded. That value setting was happening at very high numbers. VC were giving even higher. Growth VC will give even higher. So there was really, deal velocity was causing that as well. Deal terms is somewhere, here's the business plan. Let us know in 3 days whether you're coming in or out. It's a group of 7 investors who are already, part of the deal. You'll be the 8th one. And by the way, there is no board seat, there are no terms for you, there's no specific rights that you will get. But the deal is about to be closed, and you can decide in 3. That obviously is not the best way to come into any startup. So that was the other problem that was happening. Fourth kind of problem would be I'm a founder, I need to have some liquidity, I need to buy a house. So I'm going to take out $1 million from the next raise that we're going to do, or maybe more. Obviously, that's also very undesirable because investors are still in the company, totally liquid, but the founders got some liquidity. So you question whether the appetite is going to remain or not. These were things that we were seeing also develop. And deal velocity is really, every week, any deal we would see would be, let's close this in 7 days or it's gone or somebody else will come in. Now the change that has come, of course, there's a lot of dry powder. Now, some of the dry powder is allocated for inside rounds where people have done these investments. Fund would have been very active in 21. Thankfully, we were quite stable. We were just doing our regular 6 to 7 deals a year. But when you have 20 to 25 deals that got done at high price rounds, the question internally would be, who's going to now come and back these companies? And that can be a question of, do we need to then extend the runway till the company finally catches up to that valuation we gave it, right? Where you can justify an up round. So until then, you don't want to disturb the apple cart with the valuation not being or an upside. Now, what's happening really is this big question in every large investor's mind, which is, do we bridge this company to the next round, or we be selective about who we bridge? 70% of our portfolio we can bridge, not the entire 100%. So the balance 30% we let loose to the open world. Even if 10%, 20% companies don't make it, it's okay. But let's focus on the 20 that we will make sure that we are bridging them. And then the balance, let the world basically come and revalue them if it need be, or let them not get funded. So a lot of capital is being reserved actually for this lack of clarity, and that clarity will happen as companies progress and they themselves give a sense to their investors on what is the runway, what is the growth rate they can deliver, what is the end value they can hope to be at when the time comes to go out into the market again. So I think a lot of this data flow, and some founders have been slow to kind of answer this question because they had plenty of cash. I think now many of the late stage or more larger investors are getting this feedback. So this year has been more a year where funds have been making decisions on who to back, who not to back, who to let go out, right? Or to go out into the open market. We are seeing that flow happening. So internal round that does not get reported in ET is not, does not mean rounds are not happening. Because internal round, nobody puts a press release on. Right. Like ET would always say, so and so gets, and that news is not being reported. And so deals are happening. And dry powder, which is not even touching into India, Shiv, that estimate is of course $15-20 billion for Indian startups. That has been raised, is being parked. All said and done, the question really is our valuations in India, are now representing what's happened in the rest of the world. Are they still high? Are they still reasonable? That question is still there, but yes, there is a huge amount of capital that's still sitting out in the sidelines.
Well, since you mentioned, I was going to ask about valuations a lot later, but since you mentioned valuations, maybe you could just elaborate a little bit on what you do think is the state of affairs. How should people think about valuations as they are now? I mean, I'm assuming there is obviously normalization of sorts, discipline coming in, even what you mentioned around the manner in which management teams might convey the outlook to potential investors would have undergone some guardrail creation, some disciplining and all that. But just on the subject of valuation, how do you think about where we are now?
No, on valuation, what I was saying is that the deal velocity has reduced. So that means the time that we have is not pressured by somebody saying decide in a week, which means a lot of information has to flow. So the valuation is now being based on actual information
rather than deal tension,
than on just pressure, right? So now information typically leads to better investment decisions and hence some logical valuation. And that is what is happening. People are now valuing based on rational information. And that could mean two things, right? One is for what was priced irrationally before need not get fixed in a hurry, even though, especially now that you're looking at information, right? So that information is not going to actually, support that last valuation because it'll take time to catch up. So a lot of people will then again sit on the sideline saying that, hey, your last round valuation is so high. either come back to us telling us that we can choose what valuation we can give you, which may be a down round. Today, I think Mint has a cover on down rounds beginning to start happening again. And or the other is, what we are looking at, some really exciting things is where we have plenty of time to diligence. We are calling customers up, asking them for their feedback, and we're doing the 360-degree on the company, and then giving them a price offer, which is ensuring we are coming in low. We are absolutely certain we are coming in low in those companies, and that means there is that much more upside from where we are sitting at this point.
Sure. So I guess it's a very desirable situation from the point of view of the investor, certainly.
Totally buyer's market.
Yeah. Excellent. Let's talk a little bit about how Arkam has thought about where they want to focus. Bala, maybe you've identified Middle India as opportunity, as also B2B SaaS from India, as I understand it, as your focus areas. Could you just explain your hypothesis, what the opportunities, the choices you have made?
Yeah, no, so happy to, Shiv. Look, when we started the fund, as GPs, investors coming from a firm like a Helion and a firm like a Kalari, it's not that you haven't seen a bunch of different sectors and a bunch of different themes, but what really Rahul and I spoke long and hard about was, is there a generational shift, a generational theme that we think will last across multiple funds, for which we have real evidence, right? This is before we even launched Fund 1. And as we talked to the very best founders, certain patterns became very clear to us, which is there is a whole new breed of companies being formed post 2015, 2016, where the founders are completely thinking outside the big cities. And I want to be very careful. I'm specifically not talking about, India, Bharat, tier 1 city, tier 3 city. I'm really talking about founders believing that with the digitization in India, on top of Aadhaar, eKYC, on top of UPI, they can actually build new business models and new product categories to go after the next 400, 500 million people in India, whom we define as middle India, but these are families that make between 3 lakhs and 25 lakhs a year in family income, okay? And that is not the top 50 million Indians. It is also not the bottom 700 million Indians who are more NGO territory, but these are the people who have wallets, and these are the people who can actually drive significant consumption and do day in and day out. And this consumption happens to be in 4 or 5 key verticals. They are financial services, it is jobs and skilling, it is agri, CPG, it is logistics, it is healthcare, and a few core areas that form 90% of the wallet share of these 400 million Indians. And at the point at which we started the fund, this was something we were gathering anecdotally. But today, if you look at Arkam's portfolio, we've got a great set of companies and founders. You'll listen to one of them later, Shiv, that about KreditBee. Most of these companies wouldn't have existed before 2015. So we've actually gone out and deployed to what we said we would. And these are companies building brand new categories in familiar verticals digitally, right? Whether it is in financial services, companies like a JAR, companies like a KreditBee, or at the intersection of multiple verticals like agri and financial services like a Jai Kisan, people like Smart Staff doing blue-collar skilling, people like Cusmat who are doing blue-collar, VR-based blue-collar skilling for industrial workers. So we see more and more founders coming out trying to leverage the underlying digitization, which has gotten a huge impetus from COVID, and building brand new, very large categories. So that is part one. Part two is we saw a lot of evidence of smart Indian founders looking at Indian small businesses as an example and building new software products from a SaaS perspective, right? So if you look at AssignZ, which does customer onboarding for banks of small businesses, You look at a Spot Draft, which does contract management for small businesses. These SaaS companies start out in India, start out with a lot of scale in India, but now the SaaS-driven startup environment in India has changed so much that very big outcomes are possible as these companies go global. So middle India category creators, SaaS companies from India going global has really been what we have been after. And it's played out very well in Fund 1, but we think this is something that we can continue to expand deeper, but with the same framework across multiple funds.
Well, speaking of connectivity, since you speak about digital connectivity specifically as one of the enablers of being able to actually capture this category, if you look ahead to Middle India, particularly in rural areas and elsewhere, what is happening with physical connectivity? Is that also an area that is creating or will create opportunities? How do you think about that?
Can you repeat that, Shiv? When you're asking about digital connectivity?
Now, I'm saying a lot of this hypothesis is based on the digital stack and the digital connectivity that's been created. I'm asking whether there is stuff happening from a physical connectivity point of view too, right? In rural India as well. And certainly the users, the consumers in some of these locations where Middle India resides are beneficiaries of that too. So I suppose the question is that already embedded in your theme, or does that get sort of added on?
Yeah. Sorry, Rahul, what were you saying?
No, I said I actually met a company, which is actually a very good answer to Shiv's question. But why don't you give the second part first? I can give that example, Bala.
Yeah. So look, one of the big things that we have learned is it is a little bit of a myth to assume that every category creator can do everything digitally. That's not how it works. In certain categories like financial services, where the product itself is actually purely digital, right? You actually have a massive edge when you listen to KreditBee, where you realize that for collections, for even depositing money, for going out and doing credit scoring, I don't physically need to send someone, okay? But there are other categories, for example, staffing, which is what Smart Staff does, where you're finding that you have a digital platform for a large enterprise that comes to a Smart Staff to understand who are the type of workers you can onboard for me. But ultimately, Smart Staff success comes from them offering a full stack, which is I am going to be Team Lease 2.0, which means I will procure workers from a Bihar, from maybe an Orissa, to come and work in maybe factories or textile factories in Coimbatore or in Tirupur, right? So there is this whole aspect of where digitization is completely changing how physical labor moves in India, but moves with less attrition, with greater stickiness, in a way that is adding a lot more value to the overall problem set itself. So that's my example, but Rahul, go ahead.
Yes. So I met this company, or we're talking to this company, which is delivering farm input side products. So pesticides, fertilizers, tarpaulin to farmers. It's an e-commerce company, right? So far, this is being done. Everyone who's doing this saying hybrid model. The local retail store of farm equipment will be the best places to serve the farmers from. This third company is wanting to be a digital only company where the orders and the fulfillment is just like any e-commerce company. It still needs physical movement, of course, but the way they're covering 80% of pin codes. Right now, 70% of every order gets delivered, and that 70%, everything is coming from villages. So, a 5 kg packet of fertilizer, organic fertilizer or pesticide is getting delivered to a farmer in I would say a landmark in the village near the temple or near the post office or whatever, where the farmer goes, collects, etc. Now, this is a humongous exercise, right? But this is like a 4PL equivalent sitting on top of a lot of logistics providers who are last mile. And it was fascinating to hear how much tech is being built in where different pieces of this chain are talking to each other now. So while it is still a digital thread that's running between the last person who's delivering to where the warehouse is, but there is a a lot of scale thinking that we're beginning to see on this side, where the rest of India is also getting covered. And this company is, so this is a logistics provider we ended up speaking to as a part of the diligence. And they're giving us a roadmap into why that 70% delivery can become 80% in a year.
Right.
And so it's fascinating to hear that people are able to crack this problem, which is actually a very bad road, no real address type of problem getting covered. So it's beginning to happen. And then we're again seeing some fascinating stuff, which had a COVID related casualty because physical movement was restricted, but it's coming back now where, the last mile from a metro station for a factory worker, there is a mode of conveyance. EVs cracking that quite a bit. So EV, Bala will touch upon also as a theme. But third, last mile EV delivery, that's another big component of what we're looking at. So physical aspects are showing up in, in some type of a layer shift, which is a new age way of thinking. We're seeing a business which is doing end-to-end travel where multiple, and this is for middle India, where a Rapido ticket or a Rapido order is being placed by one app, and then a bus ticket is being sold by the same app, right? So you can move from Hosur Road to Domlur in Bangalore or Thane to Kafparade using multimodal transports that are suitable for middle India, but it's all happening through one app where the physical aspects are being layered up into one.
So that's fascinating, Rahul. I think what we're saying is that there are people who are trying to find solutions to the problem of physical connectivity, as much as initiatives to improve the infrastructure should create further opportunities to build on to serve the segment that we're talking about here. But that's very interesting. Thank you for sharing. I mean, I would love to ask Bala and you about some of the business models, but I don't know that we'll have enough time. We'll come back to it if we do have time later. Let's just move on a little bit to sort of, how, your process a little bit, Rahul, to you, how do you identify good companies and founders in a crowded space, which I imagine, despite the funding winter or whatever you want to call it, is still quite a competitive space, given all the dry powder and so on. And then if you can just expand on that to talk about how you help your company succeed as well, once you found the right ones.
Right. So an opportunity for us is like a three-dimensional space where the founder's ability to fill that three-dimensional space as quickly as possible is a measure of potential success. So how quickly a founder moves through that physical dimension, what it means is that they have to move from one flywheel to the next flywheel to the next flywheel, fill that opportunity space as quickly as they can, and then build a much larger business. So it's like an expanding funnel where he starts with something small, but then has an ability to keep filling this funnel up with new opportunities. So that's also typical of India, where you don't go straight like a cylinder, you go through like a cone, right? And the cone founder is really one specifically for middle India, where we're seeing multi products get sold on a single platform, multiple customers show up with multiple needs on one platform. So you build for hundreds of millions of people. Like Jar has gone from 0 to 15 million customers in 18 months. Now every customer has different needs at different points of time. So it can't be one product fits everyone because the volume of customers is so high. So you have to think, how do we access the different opportunity in this space? So what we are working backwards from that is to look for like any venture business, looking for two things in founders. One is their velocity of improvement, right? Which is how quickly do they get into the heart of the problem and find a solution. That determines the speed at which this cone is going to get filled, right? And that's how much value will get created per year, right? Because our business is about IRRs and it has to be filling up value per year. So founder has to move fast. So the quicker they can get this feedback loop getting built, the faster they'll fill that 3D space. And an example of that would be, one founder will write an email to a potential customer and say, hey, I built this template of what this great product can do for you. Please let me know your feedback on this. Then the customer thinks about it for a week, sits on it, ignores it. Next week, he'll come back and say, by the way, I looked at your template and here are my thoughts on it. Then he'll say, okay, based on your feedback, I have made these changes. Can you again look back at it? By the time he gets a feedback, he's still not built a prototype. It's just email exchange. It's 2 weeks done. A second founder will go and sit at that customer's office. He will build a half-baked working product. He'll show it to him in the morning. By evening, the guy's seen it, he's used it, he's given feedback, and the next morning, the guy's already made the changes on that product. The feedback loop has come down to a day. That's the speed at which we're seeing founders actually deliver on this value. So this velocity of improvement is actually one thing that we are, really looking for. So, again, we're seeing it in a lot of our founders, and that's why we identify that. And second is what's really motivating these founders, right? That's a big question. Is it monetary? Is it some, Padma Shri, or is it some name that will be, etched on stone somewhere? What is the main driver for these founders? And the founders we like are the ones that value customer feedback the most. Right? At the end of the day, if they feel, because that's a biological reaction. If somebody praises you, Sanctum has changed my life. My kids are going to college thanks to you, Shiv. That will do something to you, which just giving you a fee at the end of the month is not going to do. So that smile that's on your face, that's the founder we like to see, because they're actually getting motivated every day and they're solving for the customer's problem. Right? And that is what's driving you to do this for the next 10, 20 years. That much energy comes because of this biological feedback that's coming from customers. So that are two macro factors, obviously, we look for founders. But at a deeper level, I think, given what Bala spoke about the verticals, I'll let Bala talk about the playbook we have built. And that's a very specific Middle India playbook. But, that's actually working very well for us.
So for categories, so for example, in Middle India, see, a lot of people can come across, and one of the things that is really not a differentiator is simply talking about how big Middle India markets are. Even if you're a founder, everybody knows there are 400 million people. Everybody knows financial services is big. Everybody knows agri is big, etc. But what we have found is the very best founders, the ones that are succeeding, actually have very nuanced insight into either certain things that really matter from a customer perspective or certain things that are going to make the business model work. So for example, we have found that you cannot really succeed. You cannot be a company like JAR, get to 15 million consumers in 18 months if you don't solve a very fundamental problem, which is, can you think of a product that will have very low friction to adoption? Which means you're trying to build an app, and it's a savings app. It's not as if your grandmother hasn't told you need to save. It's not as if you don't have a jar at home where you put your pennies, or you go, you put your, after you have a chai, 50 paisa is left, you kind of stick it in there. But how do you really do that digitally? And there have been a lot of apps, and what really stuck out when you meet the JAR founders is they have found a way to design an app where people can be up and running literally 45 seconds. And every time you use the app, you can save in a couple of seconds, which is you bought XYZ for 100 rupees. Do you want to save 20 rupees? Yes, done. You started saving, right? So it sounds very simple, but the customer journey you have to build from a product perspective needs to be very intuitive to you, and you need to understand the Middle India consumer as to what triggers them to save, etc. Like low friction adoption, we've identified 5 other things that we think are very important to succeed in Middle India. One is low friction adoption. Second is, small ticket, high frequency. It's not about big ticket purchases, but can this particular product or solution add a lot of value, but something that the customer comes back often with a high repeat rate? You'll hear that from KreditBee, okay? That is the core of KreditBee's business, which we heard on day one from Madhu as to, if I do this right, I'll build a very large, profitable, scalable company, right? And then you learn that Middle India consumers think more daily, weekly, not monthly, annually in terms of income. They're not like everybody on this call where monthly ek paycheck milta hai, then there's a bonus, I'm looking for an increment, or I'm doing really well on a quarterly, annually basis. It's more like people for whom, if you're a farmer in the agri business, your weekly, monthly cycles are way more important, where there's no guarantee at the end of the month you earn a certain sum of money, right? So our companies like Smart Staff have understood that people might need a weekly salary loan or a weekly loan even against the salary that the textile company is paying a blue collar worker who's stitching over there, right? So when we meet founders, we assess them along these middle India frameworks, which includes, how will you build trust, for example, right? Without trust, you talked about physical, digital, nobody crosses the, I'd rather go to my local bank versus KreditBee, but somewhere you've crossed that trust bridge, right? How do you cross the trust bridge? That's a question we ask all our founders, right? And the very best founders, you'll hear a story where in one or two dimensions, they are so far ahead of everybody else you've met that you realize that this is the person I want to partner with, right? So these are just examples of what we look for. But similarly, on the SaaS side, there are lots of unique founders but the biggest issue in SaaS out of India is go to market in the US or go to market abroad, because India is only so big as the SaaS market, right? So we go to a lot of very deep depths in terms of working with them to understand what is your go-to-market. How will you hire a salesperson in the US? What is the price point at which you will hire? How will you actually build a marketing team in the US? You may think we are overemphasizing on GTM, but we are not, because that is the single biggest factor that determines the success of a SaaS company, because you assume founders are great and product is great from India, right? So given our past experiences and having run global sales teams, having built global SaaS companies, these are some of the things we do day in, day out, in addition to what we want in great founders.
Understood. I think that's fascinating. I think two things are coming through, as I receive this. The second one, of course, is execution, it feels, Bala, particularly the example you took in the context of SaaS. But other than that, it is to empathize with the customer and truly get into the skin and the mind and the heart of the customer, understand the motivations, habits, psychologies, etc. Which, as it happens, is also one of the principles of design thinking. One of the first principles is empathizing with the customer. So what's clear is, to really succeed here, you really need a very deep understanding of the behavior of those customers.
Right.
And the differences. Sorry?
Yeah,
please
sorry. I was just going to say, I'll tie it back to the original question on thesis, which is, you could make the argument, hey, everybody might have design thinking as a VC firm. But when you have a thesis where you say, I'm looking at very large markets, but with this particular filter, every day, day in, day out, you see these founders and you begin to build your own institutional memory, which then becomes our moat in the business, in the VC business, where founders say, if I'm building a large idea in Middle India, I'd rather go talk to Arkam because I know they'll understand what I'm talking about.
Absolutely. I think that makes sense. We have one of our guests has their hands up. We've requested them to ask questions. They can just post questions in the webinar chat or direct message to me, Mr. Kunal. And if there's anyone else who has questions, please do that. Otherwise, I'm going to assume that the conversation we are having is covering the questions people have, and I'll just move on to the next one. Let's just move a little further on, the Rahul, the second part of the question, which was around how do you help people succeed? Little bit, I think Bala just answered, in the sense that people who are addressing challenges or solving problems in the space that you've identified will see you as people who understand the space as well, which is, I think, what the last point Bala was making was. But just at a broader level, what do you do with your founders and companies? How do you help them succeed? What's your process? What are the key elements of, what you do there?
Yeah, Shiv, absolutely. So we've had journeys which went from first check to an IPO. That took 8 years, and obviously that's a long marriage, right? Where you have to go through ups and downs, and you have to keep the relationship strong, because at sometimes you are cheering and sometimes you are pointing out hard points that the founders are missing out on. Some things we try and do preemptively so it does not become a problem later on. It doesn't become like a new habit that the founder has to develop when the market is crying out loud for that. One of them is governance, right? Where if transparency is missing in a founder, we hope that we actually benchmark founders on their ability to be transparent upfront. But let's say it's lacking in some cases. We want to ensure that they think of themselves as people who are okay to be talking about failures as much as about success. And that needs some kind of a, almost like a parental thing where you tell your kids that it's okay to, you don't have to be successful only for us. Right? Investors are not here to just look at your success. We are okay to help you when you're going through so I think that relationship has to be built with founders where they're okay to talk about problems as well, which means you have to spend a lot of time with them, of course. So I guess some areas that we cover: governance, under this thing of if you are okay to be vulnerable with your team, with your investors, it's fine. We are here to help, not critique only. And then governance becomes a thing, right? And then you set that habit, and by the time late stage investors come, then you're not running into issues where information is being hidden or misinformation is being related to investors. So hopefully we try and set a habit for that. Number two is that at the stage we come in, which is a series A or a pre-B, it's like maybe a year or two before companies start scaling up, or they should be scaling up. So typical challenge is that the founder holds on very tightly to the reins. Every department, every function has to be managed directly by the founder. And the loosening of that is where outside professional manager has to come and take over some parts of the business. Only then a startup becomes an organization. So the organizationalization or the org build of the startup, that's the second area we work on. And that's a lot about how do you even start thinking about what kind of org structure you should have. Recently, we helped a company actually think through the best way to manage two different parts of the business. And then that was an exercise we did with one of our internal advisors to that founder, who spent a bunch of time going over the needs of the business and saying, this is the best model. From a practical standpoint, some founders will have this mythical idea about this is the kind of org we will have, this is the guy we will get or girl we will get, who does not exist in the market, right? This is a magic figure who has to, but you go around hiring somebody with that spec, you will never find. So that realism has to be brought in, that the market only offers so and so professional capabilities. So you have to be realistic about. Otherwise, every founder is happy to say, if I get somebody like this, I'll be happy to give over control or let this be run by somebody else, right? So that is the other big part of it. And the third part is, of course, the go-to-M. As they prove their product and they're going into new markets or they're launching new products, the GTM of that is something we work closely on. And that has to do with, again, understanding market pricing, margins, sales costs. And we've broken this up into three parts. Vishnu looks at governance. He's the point of control for that. Bala looks at GTM. I look at org. So the three of us actually own these value add areas. And then we bring in outside help as we need to help our portfolio. So hopefully we'll, have more, more boats floating or in a market like this, more chances of success in our portfolio when we do this.
Thank you. It's just, I predictably painted myself into a corner here in terms of time because of this fascinating discussion. We've got a whole bunch of questions that have come through. I'll just put them out there. Rahul, Bala, you can decide who wants to take it. My request is if you can spend 1 or 2 minutes, unless you think that there is more insight that needs to go into the answer of each of these questions. The first one, it's a longish one, is this is from Mr. Rajendra Valsalan. Accurate third-party market research is critical to ensure validation of assumptions made by startups on products, pricing, problem statements, solutions, competition, offering, and gaps. This is a critical value determinant. What is the gold standard used by funds to validate the promoter research and internal data available? Who does your business due diligence if you get business due diligence done, or hypothesis, business, everything due diligence? Sorry, please go ahead.
Yeah, I'll take a shot at it. I think, look, the stage at which we come in for most companies is maybe if the company is doing, $1 million in revenue, that's a, 1 to 2 million in revenue is not atypical. Okay. So at this point in time, all those factors are really important for us. And let's just assume that we have checked off the box in terms of the founder category fit, etc. The way we end up doing a lot of this is referencing the value proposition of the company across the entire value chain. I'll give you, and Shiv, I'm cognizant of trying to answer this in a minute or two. So for example, we are currently talking to a particular company that is providing a managed marketplace for manufacturers to deal with highly engineered goods and supplies from Coimbatore and a lot of places like that, right? So in this particular case, there are a bunch of manufacturers who come to this portal, but the portal then takes the design from the manufacturers, and the claim is that we are able to go to 30 different suppliers of engineered products in Coimbatore and actually come back with the right supplier and then become part of the production supply chain of this large manufacturer. As we prove our worth, one day we're going to be 30-40% of wallet share of this particular manufacturer. We do that across 100 manufacturers, and we are an IPO-able company with 20% margins in India. Great story, right? So for us, we then start from the basics. We talk to 10 of their manufacturer customers. We talk to 20 of their suppliers. We actually go through, try to understand the pricing assumptions. But frankly, at our stage, there aren't market research providers whom can actually do this because they don't have the context of the company the way we do, right? But if it is a slightly later stage company, if you're coming into Series B, we may very well, employ somebody to do maybe more of technical due diligence because the product platform might have gotten larger, etc. But the basic point being, we reference check on our own as GPs and our team every aspect of the value chain, the product itself, and then make assumptions on what kind of pricing will hold, what types of margins will hold, with a significant pinch of salt over what the company is projecting.
Okay, thank you. That's a thoughtful answer. I imagine one way to think about it is that the contextualized reference checking that you would do for different things using different sources rather than any one place.
It's
for
reference
everything.
checking and business model pressure testing. Let's put it that way.
Absolutely. You're right.
Yeah.
Look, I think, all of these questions are quite...
Just to add quickly to that, Shiv, Vishnu's been through 2 unicorn builds. And those are Rivigo and Cardeco. And there's been an amazing amount of physical build as well as, all the issues related to what India is all about. These are very hard businesses that were built. I think the thing I want to illustrate with that is that even internally as people with the kind of strengths we need to validate information. Recently, we were looking at a company where between a couple of triangulations that Vishnu did, we could pick that the numbers had issues with them. And one of them I remember was GST data, GST filings that we looked at, and we wanted to log in ourselves and see. And that's again thanks to some of the public rails we have access to the filings. So that's one more thing. So again, no third party, but third party in the sense that we can go and do research now more on data that's available than before.
And I guess triangulation is in any case the name of the game in respect of matching multiple sources of. So look, I fear that we have 8 more questions and they're getting added on, and I'm conscious I'm explaining this, which is also taking time, but I need to. I run the risk of doing this force fit answers to some very thoughtful questions that we've got. So what I'm going to suggest is that I'll just go with the questions. Do try and make them brief, but complete. And then if we don't have time for 3 or 4 more, our team will take down those questions and get answers from you and get back to the people who've asked those questions. Because otherwise, I don't think we'll do justice to those questions. So I'll just move on to the next one. Let's still attempt to keep it brief if we can. How do you think generative AI will affect B2B SaaS startups? Bala, if you could have a quick take on that.
We are working very actively on this. I think you're going to have 2 types of outcomes. There are many currently funded B2B SaaS startups that might find themselves in some spot of bother because of what generative AI is bringing to the table. At the same time, there are a lot of new ideas in SaaS land, for example, in say B2B sales enablement, where generative AI is going to allow companies that have got started over the last 6 months to really create a new category. So you're going to see a lot of positives and negatives.
Sure. Okay, let's move on. With regard to, it's a SaaS question again, with regards to India building for global SaaS, how do you see product development cycles shaping up for SaaS startups, building for world, considering there are multiple iterations required on the basis of customer feedback? Do you see Indian founders, I suppose, point to the question, do you see Indian founders having the ability to empathize with global businesses?
I think, the short answer is yes. And the reason for that is there are now been 2 generations of Indian SaaS startups, and the people who are founding these teams increasingly have deep roots in the US and Europe, and the customer feedback cycles are way faster than before. And the average SaaS startup in India with even $1 million in ARR, if you're not able to show a few global customers and globe is your market, it's pretty challenging to move forward.
Thank you, Bala. And, as we take these answers, Rahul is also picking off some of the questions and answering them. And if you still have follow-on questions, again, we'll need to take them offline. Madhusudan has also joined us. Hi, Madhu. We will get into introducing you in a few minutes. We just want covering off a couple of questions from the discussion that we've been having, Madhu. So just bear with us for a few minutes. This is from Disha, in the current market, do you think startups should still wait till they turn unicorn to go IPO? Why not do so sooner, once they reach profitability and then grow naturally? I'm adding to this question. Is there a rule of thumb? Is there a way to think about this? Rahul?
I think, the prerequisite of that is that the late stage investors don't make it again, the need to go public at a certain valuation is driven by the markup they want to see from the last round. And it's but if you apply to a startup which is in the 200-300 million, likely to turn profitable, then absolutely there is no pressure to become bigger. The pressure to go out once unicorn happens is really more from a private investor's comfort to keep backing it till it's a unicorn, right? That keeps it away from the public market. Now what's happening is that late stage private investor is gone for the for the most part of it. Every late stage company we are looking at is turning the knob on profitability sooner than later, even in this market. So what is likely is that every founder is actually taking the profitability path. We'll have a lot more well-baked margins built into companies. If the late stage guys show up, they can choose to stay private longer, come out with a bigger scale, with a bigger offering, but it'll still have very solid margin structures. But I think Disha's question is very relevant, which is if you remove a lot of these prereqs, then it makes absolute sense to go out sooner than later, grow with the market.
And I think to an extent it answers Gautam's question, Rahul, if you just eyeball that after this on IPOs. And you also talked about profitability, which is also mentioned in another question in respect of how that is happening. And we've talked about it a couple of times. So there was a question on profitability. There is a question on what are your top sectors which you feel have scope and opportunity right now, right at this time? And are there any sectors which are complete no in the current market? I suppose speaking of it in the context of current market sounds a bit tactical, particularly when you're thinking about this in a long-term sense. But Rahul, would you like to talk about that?
Yeah, so
sectors to focus on, sectors to avoid.
Yeah. See, fintech we think has massive, actually all our sectors we think have massive depth. Some are early in their transformation where the business models are seeing, because see, even in fintech, we have seen this very confused 2-3 years where it was more leaning towards offline than online, right? Markets were saying, oh, online is happening, let's try and convert it into some form of hybrid model. But at best, it was looking like this confused monster, which was both online and offline. The model was still not, I would say, elegant in terms of what will scale. And that was how fintech used to be 3 years back. Now we are seeing fintech, which is a lot more, scalable because it's leaning more towards digital growth. Some sectors I would say are like fintech 1.0, like health tech is very much there. You're seeing a lot more physical aspect in the business models as we saw in fintech. So I think we'll keep tracking those. We are not like jumping into health tech as much as we would in fintech. So again, gradation wise, what are we more excited about? Fintech, absolutely, we see now in a 2.0 phase. Other emerging areas, we are excited about SaaS for sure. I think there have been 2 questions, so I won't go into why and what. But the third new one, which I have written also about, is that we see Indian manufacturing becoming more formalized for global standards. And in that, we are seeing 2 kinds of models. One is just factories improving their processes and price and discovery processes, as well as delivery processes. The discovery of demand and the delivery of supply. Both processes are being formalized. So that's on the manufacturing. And second, in that manufacturing is just the B2B part of it. So an ability for a fabrication company to do quicker fabrications, show it to a customer, get the order, and then ramp. That process itself, there's a company that will be a marketplace for doing quicker fabrications. So, we're seeing these emerging areas where manufacturing is going to get accelerated and be at scale with the rest of the world. And 2 areas, I'll let Bala speak quickly about EV and of course, drones. Those are 2 exciting areas we're looking at.
Yeah, so in addition to what Rahul was talking about, in every fund, we look at what we call emerging tech, where we think there are areas that are around the corner. So we've done a boatload of work on the EV space. We think there's almost no question in anybody's mind it's going to be big in India. So, we've been looking at various aspects of the EV value chain, even including financing over there. And drone tech is pretty big again in India. So we've done some work in that space as well. So I think there are a bunch of these emerging areas that we continue to investigate. We'll definitely be doing more of that in the next fund as we go forward.
What we have come to the conclusion that is not that exciting is influencer commerce, or and certainly short form video. We feel YouTube Shorts are going to be the dominant YouTube short form videos for most Indian consumers, and influencer economy is is going to take its time to develop. So that's the other one we've been looking at, but we're not really, because that really was some kind of a livelihood generation which resonated with our thesis. But we've come to the conclusion that really it's very hard to do that. So that one we are also avoiding.
Thanks, Rahul and Bala. Look, there are a bunch of other questions, including some fascinating ones around copying business models from abroad versus creating our own categories. Bala and I were talking about that at some length just quite recently. My request is that as we start chatting with Madhu, perhaps, Bala, you could take the question on the screen, if you can see it from Mr. Dayanidhi on the screen. And Rahul, there are a couple I think you could check off. And then what's left, we'll just get back to people afterwards. Madhu, if you could welcome you on, if you could switch on your camera and we can, thanks for waiting patiently. Very warm welcome, folks, to Madhusudan E. He's the co-founder and CEO of KreditBee, which is an instant personal loan platform for self-employed and salaried professionals. It has millions of customers, and as I understand it, billions of dollars of disbursals that it's done in the last few years. I understand the success of the platform is a function of their deep understanding of their target customer, something we were talking about before with our panelists, designing a fully digital lending journey, managing risk, and of course, low-cost customer acquisition, which has been quite a key thing as we understand it. And today, they're one of the fastest growing and most profitable operating-wise, I think, digital lenders in India. So congratulations on the success of the company so far, Madhusudan. Perhaps you could start by telling us a little bit about the KreditBee story, or the KreditBee story more so, your hypothesis and what it's taken to build a profitable and scaled business in a segment that no one thought was credit-worthy a few years ago.
Hey, thanks, Shiv, and really thanks for that great introduction, right? So I think probably you spoke half of what I wanted to speak anyway. So, so just getting back to, the entire concept of KreditBee has definitely evolved, right? So when probably 6 years back, when Bala used to come and meet us, I think that time the idea was survival, right? Ki matlab dhanda to chalna chahiye life mein, right? So that was the idea. But I'll tell you what we were trying to solve, right? So I predominantly worked in an e-commerce industry, right? Prior to getting into the startup, 2016 is when we started. So I'm talking about like 2014-15 timelines. And the interesting factor there was while I was handling multi geographies, not just India, but a lot of Southeast Asia, Latin America, Middle East, and whatnot. We are always focused on looking at how the e-commerce itself has grown in the matured markets like US, and China was gearing up at that time. And so we were kind of taking references from there. The biggest difference what we found is while e-commerce as an industry itself was evolving, on the credit side, in India and many of the Southeast Asian countries, apart from this credit card, there was no other financing options, not just on e-commerce, but in the entire internet space. And I think that was the trigger for me. All right. So, and again, a second step was to look at what is the overall credit card penetration itself in India. That was very small. Again, now we talk about 3%. I think back then it was like 2 or less than 2% kind of a penetration, right? So the space was pretty large. So when the space was large, I was in that industry. I was looking at a lot of internet customers, consumer behaviors and whatnot. Wanted to give this, I was totally excited with this, the overall opportunity that was there in India, right? So, and that's how we kind of got together to start with and whatnot. I think from 2016 till 18, we were both doing physical, digital kind of a nature of lending. Not everything was digital. The India stack itself was kind of coming up brilliantly, but it was not in use yet. Many customers were not trained to kind of use that and whatnot, right? So, but we've kept on to the thing saying that, we believe that, doing everything complete digital disbursement, totally automating that loan process, and as well as the underwriting, not just the credit worthy customers, but also the new to credit customers. And again, take a step towards metro, non-metro, tier 2, tier 3, what Bala always calls it, as middle India, right? So mid India, right? So I think when looking at that particular space, how do you underwrite and whatnot? I think this is what we wanted to basically solve for: automate the loan process and underwrite not just the bureau-based customers, but the 80% of the masses which were not having any kind of a digital footprint or the banking footprint on the bureaus, right? I think with these two things, when we started, we launched the app KreditBee in 2018, 5 years back. And that was an overnight success for us. So I mean, just to kind of say some numbers, first month we did about 2.5 crores of disbursement. Second month was 10 crores, and fifth month we were doing about 100 crores of disbursement in a single month, right? So the product market fit was so great. It surprised all of us, within the team. I used to give, I'm in a reverse problem now, but those days I used to give certain disbursement or the business estimates to my investors. And it used to be beaten left and right. I mean, it was like, if I say that I'm doing 50 crores per day, I'm doing 100 or 150 crores. So that was the beauty or the magic what you see when the product market fit kind of really happens. And we were not spending anything on marketing. It was totally organic growth for us. 90% of the customers used to come to us organically. Sometimes we were surprised कि भाई fraud तो नहीं हो रहा है या कोई bot तो नहीं कर रहा है, right? Because if you're looking at 90% of the folks are organic, and then we are not even spending the marketing dollars because we didn't have enough money to lend out. I mean, that was our problem. While the demand was great, but we didn't have enough money to lend out those days, right? So I think that's how this particular industry started evolving, right? So and that led us to understand, the potential of, while we spoke a lot about the potential of Middle India and everything, but experiencing it firsthand was a real excitement. Right. So I think, of course, after that, of course, among the few early investors was Arkam, but after that, everyone started believing in the story. Everyone took this, the entire growth story. They were appreciating the growth and whatnot, and it was like a more or less a bull run for us. We were profitable by FY19, FY20 also. We were profitable. Our PAT was about like 130 crores and whatnot. Super profitable. Everything was seeming like, whatever I touch, turns to gold, right? That kind of a story. But again, all good things has to stumble, and definitely, the COVID happened, right? So that was a time of chaos, definitely, so we really did not know how the personal loan industry would behave. And especially, while banks would be at one end, but we were more on the digital side. So, whether the experience would be different and whatnot. So that was a very chaotic moment. So we saw a lot of ups and downs. I mean, I've seen those, the bull run periods versus these kind of catastrophic moments of, COVID and wave 1, wave 2 and whatnot. But luckily, I think, for whatever the hard work that was done by my risk team and in underwriting and whatnot, we did not suffer huge losses. While our previous profits was able to kind of take care of our losses for that COVID year, right? I think in that ways, the net equity was never kind of negative. Whatever we had raised, it was intact, and all the glory profits what we had done was kind of taking care of the virus there. So again, back to principles, a lot of learnings about how the customers behave on such events and whatnot. We were not doing enough disbursements, so further understand the market and understand the customer. Who are the ones who are paying? Why did the people did not pay? How the migration population is working? What kind of jobs are susceptible for these kind of economic shocks and whatnot? I think that was the learning that happened, and God's grace, again, we are back to profitability by September 21, and things moved on. I think just for the recent numbers, like March, we closed at disbursing more than 1,500 crores. And we clock a revenue of over 150 crores on a monthly basis, right? So, and of course profitable. I mean, let's not go into the numbers, but yeah, even on a monthly basis or a yearly basis and whatnot, right? So, and a lot of funding winter being talked about, but we were lucky enough to kind of close our Series D as recent as Jan. Advent and MUFG Bank, Mitsubishi Bank, kind of led that particular round, and apart from Arkam, we have the Premji Invest, TPG, and Mirai, and ICICI Bank, Motilal Oswal as our investors. Yeah, I think yeah, that's the intro piece. But over to you, Shiv. Yeah.
No, that's wonderful. Congratulations on the fundraise as well, and as well on the marquee roster of investors, starting with Arkam. I may be a bit partial here, but then all of the others that you named. This is a great set of names. As an entrepreneur myself, I can totally understand the ups and downs of these journeys, and they don't come from areas that you might expect or that you can never fully model. And you've obviously managed through those journeys. I wish you, go back to the kind of surprising success where you feel like King Midas again on an ongoing basis for many years to come. Can you tell us a little bit about the scope of the company, Madhu, in terms of size? How do we think about, we say it's a scaled profitable company, just to understand the scale of the company. What scale are you operating at?
No,
How
as
do
I
we think
mentioned,
about
right. So last month we disbursed about 1,500 crores in a single month, right? So that's what we do it. So roughly we do a business of disbursing close to about 50 crores and odd on any given day, right? So that's the average. Of course, weekend goes down. So at max, we have even done 70-80 crores on a single day itself, right? So I think that's the scale at which we are operating. We roughly process more than 50,000 new loan applications. Our approval rates are at about 10-12%, and we end up giving out close to about 8 to 10,000 new loans on a daily basis. So I mean, some of the other numbers would be like,
customers that you've touched, for example, and you've obviously changed a lot of
overall,
lives.
I think we have lended out to close to about 60 lakh people. I hope all the audience are Indians, right? So I may be using lakh and Hindi words and all that. Right?
Yeah,
so,
pretty much.
Yeah. So 60 lakh customers is what, no, not 60, 70 lakh customers is what we have served in our lifetime, who have ever taken a loan from us. And these days, every month I collect EMIs from about 40 lakh people, right? So, so that in terms of number of customers from whom we transact or collect EMIs, I think we are comparable with, some good sized banks, right? So, and of course, our ticket size are roughly about 40,000 is the average loan size. In terms of the quantum, it may not be as high as to be compared with a scale large bank, but in terms of the number of customers, transactions, what we handle, very much there, and then bigger than some of the very well-known banks also. Yeah.
Sure. Thanks. I mean, it's actually quite astounding, these numbers, when you think about it, and in the time that you've done this in a whole new category. I'm just going to tell our guests to post the questions like they've been doing before. If they have any questions for Madhu, we'll just pick them up whilst I continue to ask him some of the questions that people have asked us to ask you anyway from before. Madhu, just going back to the hypothesis and the business model, when you started lending to the unsalaried, new to credit was historically ignored, right? And people, as you presume, higher credit costs the whole cost of credit assessment, higher credit risk. So how are you able to lend to this category, keep your credit costs under control, manage your, NPAs, etc.? What is, what are the learnings from your business model that makes it successful?
No, I think let me put this way, right? So so this is, I'll just frame the question also in a different way, that any investor or anybody whom I've talked to, probably they'll ask ki matlab aisa risk mein kya kar rahe ho, right? So what is that? So typically we are about like 3.5% loss making company, in the sense that credit loss, right? So I mean, just to clarify that, in any given month, if we lend out 100 rupees, then we collect 96.5 rupees in principal, right? So I think that's the way it is. Now, the idea is there is no, I would just put it this way, that there's no secret sauce to this, right? Okay, there are 2-3 variables, what you use it, and then, your risk assessment ability will become like greatly different or something like that, right? So I think the way I put that is, anybody can create these scorecards, data science engines and whatnot, right? Somebody might have hired from, MIT, somebody might have hired from, our IIScs of the world and whatnot. And then that particular thing is a little generic, right? So anybody can hire with sufficient amount of funds that I have a decent data science team, and then I put them to create the models. The models may be efficient by, about like 10% here or there, right? So somebody might have created a beautiful model, somebody might be like 10% needs improvement, somebody might be kind of 10% above you and whatnot. This is not the differentiator. And amount of data what you can collect, right? So is let's say that 60 to 70% of data sources what we use are generically used by everybody. There's no difference in that also, right? 60 to 70%. Now, the biggest differentiator happens in terms of how do you manage risk is these models or scorecards, whatever we have created, how much of data have you already kind of pushed in so that they start behaving, in a more efficient and a robust manner, efficient manner, and an accurate manner. I think that's the key difference. So for example, like as I was talking to you about, we used to get a lot of organic traffic. I mean, today the organic traffic is 50%. I've seen the days when it was 90%. And we have built that enough, this customer source who have been fed into these particular models. The nature of these models is that they self-run, self-learn, right? So, there's a lot of mistakes are, you have like this NPAs of like, let's say you've done about 100 crores of disbursement. There's 5 crores which has gone bad. 5 crores has gone bad from 50,000 people. So you sit and analyze those 50,000 people to understand what is the common variables among these 50,000 folks who default, right? Then you get some set of variables. Now, the more and more you get it, that is what kind of makes these systems or these data science models more accurate to predict what is the behavior of the incoming cohort. Right. So having while the active borrower base would have been about like 7 million, but we would have underwritten over to close to about like 50 to 60 million customers, is what these engines have underwritten, so that they have learned from all this data to kind of predict accurately, right? I think that is the biggest differentiator. Now, why not somebody comes and create it now? Yeah, it takes time, right? So 4-5 years is something what you have to wait, and a lot of things has happened in the industry. Industry has evolved. A lot of guidelines have come in, so that becomes like a one barrier, right? So second thing is that those days I used to acquire customers for lower CACs. These days, if I have to kind of recreate this company and then recreate this engine, the amount of marketing dollars that I have to, kind of push into the market today, because there's so many companies are there now. Everybody is spending, right? The market has matured, or the industry has matured. So the CAC that you have to spend to get the similar learning starting from today is like at least 3x or 4x of what I have spent.
Right.
Now, that means like your profitability numbers are going to be kind of postponed, then the investors, already there are some established player like us. So all these things are the ones which creates the barrier, rather than to say that, we have kind of, God has graced us with a couple of variables, which I turn it on, and then, that makes the decision for my, the risk and everything. It's more about, how much data you can kind of push into this, right? So not just that, the other piece is to say that the other differentiator, for whatever reason, among many of the fintechs, I'm not generalizing it, but more or less whatever I have seen it, apart from collection, this entire lending thing is very, very jazzy piece. Right? Pura digital loge, all you're sitting with, the digital marketing guys, and you're sitting with some data science guys. You're sitting with the engineers and whatnot in a cool office and whatnot, right? So that's all very jazzy. But I wouldn't call it as a dirty piece, but the most headache piece is something like collections. So the collections is the one which makes or breaks the bottom lines. Okay, so that's how I would put it, right? Now, in that ways, unfortunately, in the earlier days, I think now things have changed totally. But in the earlier days, what I'd seen was many of the fintechs were kind of always trying to outsource these collections to outside, saying that ki bhai hum log nahi karenge. Matlab there are some, you know, these collection agencies which are sitting in some, you know, they have to operate very efficiently and then, you know, very optimally so that their offices are not so cool. And, you know, वहाँ पे लोग ज़्यादा रहते हैं, unionization बहुत होता है. I mean, in an engineer sits at a 10 by 10 square feet में एक बंदा बैठता है तो 10 by 10 में वहाँ पे 3 लोग बैठते हैं, right? So that kind of a messy office is there. So it's not so jazzy, so I'll outsource it, right? So I think that was, although it, you know, what we believed was like, bhai, matlab, we cannot outsource our headache to somebody and then ask them to solve for us, right? So when this is the most important piece that makes or breaks our bottom line, then we should be having this headache and solve for it, right? I think that attitude actually changed a lot for us. You know, it might look very simple and whatnot, but sometimes these decisions and then these, you know, these course of actions really defines the company's balance sheets or the company's loan book performance and whatnot, right? So I think that was the real differentiator. If I could see that, you know, what happened in the journey, alongside many other people, we did a lot of things in-house versus outsourcing it to somebody and then expecting them to perform for our results. Yeah.
Thank you, Madhusudan. You know, I have to say, as a management person, what it actually reflects is a very clear idea of the sources of competitive advantage that you have, whether it is the manner in which you gather and manage data or understanding which part of the value chain is really going to move the needle quite a lot and then making sure that you've invested in it. And this is how moats are created, frankly. This is how it is done. So congratulations on that. I'm planning ahead. I feel that we will run out of time. So I'm going to start bunching up a couple of questions, and we're also getting some questions from the audience, Madhu. Well, first question, of course, comes from what you were just answering. You touched upon 2 points, which I wanted to ask you on. One was competition. I was reading somewhere in an interview, you were talking about this being a large enough space for everybody. Having said that, you just talked about barriers right now as well. So how do you think about competition? So that's the first point. And the second is what's happening in regulation in fintech, and you know what is it going to mean for your business and for fintech in a broader sort of way? If you could you just take those 2 questions, then we'll move on to the next one.
You know, first thing is with respect to the industry itself is pretty large. You know, so I don't think we are growing with a large push ki matlab hame itna karna hi hai bolte, right? So we are growing at a pace where we want to manage the risk. Let me put it that way, right? So we don't want to grow at, I mean, why only 1,500? Why not 2,000 crores on a monthly basis? If I just open up the tap for there, do I have enough collection folks to kind of collect that? Am I prepared for that? You know, do I open it to many other geographies? Do I open it up and then experiment in different job profiles of the people and everything, right? So I think the questions are that rather than to say that whether industry exists or not, doesn't exist. I mean, this is a developing country. Yaar, pe to credit run hai. With all the increasing taxes and everything, koi save hi nahi kar raha hai. And the aspirations of the middle class is to basically grow with, you know, improving your own lifestyle. You know, the status quo of the middle class today is that ki bhai mere ghar mein, whether I have a flat screen TV, whether I have a sofa set, whether I have a two-wheeler for my daughter, son are going to, you know, their colleges in a two-wheeler or not. That's the aspirational, the middle class, what India today has got it, right? And this is actually fueled by the credit, right? So in that ways, as long as this economy is growing and it is a developing country, we are not a rich country, right? So the credit has to come in one way or the other for all these aspirations to be kind of fulfilled. So in that way, the market size itself is pretty large, and still we are not done away with all these unorganized lenders who are there. They are also playing a much predominant role in the Indian ecosystem. I'm not saying right or wrong about them, but the only thing is that the customers don't get benefited about their repayment behaviors in any kind of a bureaus or something like that, so that, you know, they cannot get a lower rates, they cannot upgrade to a bank customer and whatnot, right? So that's the issue with the customers. And of course, the internet penetration and internet education. I mean, today, if I go and ask my mom or any 50-year-old plus to kind of deal with a loan fintech app, you know, it has a lot of KYC process. By to apna Aadhaar key in karo, face match karo, you know, you take a selfie and everything. So that education is also kind of there within this the below 40 kind of age people. I mean, beyond that, I'm not talking only to the metros. There are a lot of exceptions. 75% of my customers are from non-metros, right? Beyond 35, 40 years, when we see these people behavior, they cannot actually deal with our app. right? So there is some kind of an education that has to happen. So in all that sense, market itself is pretty large. I don't think like, doing this numbers, whatever we are doing, it's just the tip of the iceberg, so in terms of the entire industry I'm talking about, right? So as an industry, we might be disbursing close to about like 5,000, 6,000 crores, including Paytm, us, and there are a few other guys. We should be doing about like 6,000 to 7,000 crores or $1 billion at max, right? So but again, you go and talk to any of these guys, whether they have kind of found any kind of a arrest in the growth, or are they kind of really pushing hard to kind of increase the numbers? I don't think that's the answer. Now, talking about the regulations and whatnot, so what has happened with the regulation is like, there was this period pre-COVID and just after COVID, this industry was kind of growing at an astronomical pace, wherein there were, just to give you an idea, before one of the key regulation came in, there were about 1,600 lending apps on Google Play Store, right? And post one of the regulations back in 2021, right? So that number came down to 84, right? So that means that it was exploited by even the non-regulated entities, fly-by-night operators, whatever you call them, right? So it was quite exploited, and imagine that the space was very good, and those days we were also growing, at a month-on-month good pace. Still, there were 1,600 apps, by the way, right? So because of that thing, the industry would have got really unmanageable if the regulations had not come in time. And therefore, thanks to RBI and whatnot, by bringing down a lot of sanity towards how this industry has to be run, and a little bit focusing on having licensed entities to more do it. In a way, what happened is, it did not really hamper us a lot, because we had a homegrown NBFC, and then we were NBFC focused. This was one thing, right? So both the fintechs and the investors were divided in this particular thought that there was a point where if you have an NBFC, investors are not funding such companies. This is outright. They used to say कि भाई मतलब हम लोग पैसा नहीं डालेंगे because it's a regulated entity you are running. I was like, भाई मतलब regulated काम करने के लिए regulated entity तो चाहिए ना, right? So that was my idea, but many people did not like it. I'm telling you upfront, right? So, and then when the regulations started coming in, अभी मतलब nobody wants to invest in a platform, pure play platform. First thing is like, भाई आपके पास NBFC है क्या? And many large companies are fighting for getting one license. I need one NBFC license, and they're not getting for years, right? So I think that shift has changed, right? So that's what kind of regulation has made the difference. It has really made a difference to those companies which did not believe in owning up a regulated entity and running it as a pure play platforms. But for whatever reasons, our thought process shows that we need to have an NBFC from day one, right? So we started with as an NBFC business. So those businesses, I don't think have much of an issue for any regulations coming. Whatever the regulation states is whatever is there for a regulation as an NBFC. If you look at the master guideline of NBFC, that is what is cut and in pieces and then shown that ki bhai aapko ye sab bhi karna hai if you are running it as an app or a platform, right? So I think with an NBFC focused models, the impact was not so high.
Thanks, Madhu. Question on the work you've done with Arkam, and if Rahul and Bala can also comment. I understand that Arkam was some years ago the first Indian institutional VC in KreditBee when they started. So what has been your experience with them as investors? And please be candid. And then of course Rahul
Bala,
and Bala
you
can also comment. आप कुछ भी बोल सकते हैं.
Yeah. No, I think this was the time when we were struggling for an institutional Indian VC to come onto our cap table, and me and Bala go a long way, because even in his days in Kalari, where I went and met him, and then he did not invest a single rupee there.
I knew that was coming.
So I went and pitched him. The valuation was still lower, and the check size, my request was also very small, but still at that time he did not believe it. But anyways, that's how our relationship started. But we kept in touch. I was updating him some numbers, and we were discussing here and there about what's happening and whatnot. And when they came out, when he and Rahul came out and started this, I think Bala started visiting our office. Ki, जो भी numbers बोल रहा है कि वो सही है कि नहीं है. मतलब the numbers were really looking like it was really on a good pace, as I was talking, right? So we are growing more than 100% on a month-on-month basis and whatnot. while it is very good to hear, and then I think he had his own doubts कि मतलब मधु ऐसे ही कुछ बोल रहा है कि मतलब कुछ चल भी रहा है, right? So I think that's how we started spending more time in me explaining the business and whatnot, right? And they took that bet at that time. Those were the days when I spoke a lot of other large institutional funds, domestic and those guys. I think they came in when the business was already there. I think there is that 0 to 1 stage and then 1 to 10 stage, right? So most of the investors who came into me with the bigger brand names was like when we were just about 1 to 10 scale or 10 to 100 now, where we are trying to kind of move ahead and whatnot, right? So I think the real crux comes in between that 0 to 1. There you don't have all these, teams, and then, you don't have all this lot of resources to showcase ki aap kya kar rahe ho, and then the numbers has to be backed and whatnot, right? So at that time, trying to analyze and then find out that these guys can really do the work. I think that's more of evaluating those founders. मतलब ये लोग कुछ कर सकते हैं कि नहीं, of course the market, industry and the business is one part, but the real part comes in about the assessment of the team itself. I somewhere there, that's where they took the call. It would have been very difficult because that was the first investment they were doing it, or one among the first ones what they were trying to do at that time. You as an investor, he will also have a lot of fear about not the first bet going wrong, and in a way I think we both found ourselves pretty lucky in that, right? So where we grew and their fund grew, and they did participate in a previous to not the last round but the previous one, Series C round, is when they participated. But many times I do bounce back a lot with Bala. He comes and walks into our offices and we have some of this strategic discussions. He comes from marketing background a lot, so in his previous career, I think he was in the marketing side, and we debate a lot about all this branding, marketing, and whatnot, and some of the strategies. And all these investors are somewhere are so intelligent that with 1 or 2 guys you can manage as an entrepreneur easily. But now today I sit with about I don't know 10 or 15 of them. I get stuck with 2 intelligent minds, so therefore I need to kind of get out of such situations where Bala comes in handy to understand कि भाई मतलब ये लोग दोनों ऐसे बोल रहे हैं तो मैं कैसे निकलूं यहाँ से, right? So those are very important things to kind of get him as, sound him off as an advisor to me, right? So and I don't talk to him like I need to kind of somewhere make him happy about my numbers or always talking about the cooler stuffs. Whenever I call him, I think there is some issue that I have to discuss. Otherwise, just to state my numbers or something like that, I would never call him. Yeah.
Really, you have a pretty deep relationship that you have built up through the course of this engagement with Bala. But look, we are out of time. Madhu, I want to ask you, do you have 10 minutes? Because I've got 2-3 questions for you. Can we extend this by 8 or 10 minutes?
If you have time. My next meeting is actually at 6, but till 5:45 we can definitely do that.
So we'll just do that. What we'll do is we are beyond the scheduled time. I'm just going to carry this on for another 10 minutes or so we can get 2-3 questions from that people have asked us. Bala, I'm sure you might have wished to comment on what Madhu was saying about this thing. Maybe if you could just do that in a minute, then I can get to these questions and then we can close after that.
Yeah, no, look, I don't have much to say to what he added. I think, we've been fortunate to be able to partner with someone like Madhu. And look, the company is at a stage that you would want all our early stage companies to be, with a lot of late stage investors, a lot of board advice. So, our value add to companies is at an earlier stage, but it's also it's always very pleasing to get a phone call from Madhu, even if it's at 10 p.m. and it's something he's struggling with. Whatever we can help with, we do help. So I don't have much to add. He's just a great guy. Yeah.
He's a early guy to go to bed, and I generally I'm on the reverse side, so I always catch him up at late night, and I miss all his calls, what he calls in the morning anyway. So
some of it might be on purpose. Some of it might be purposely designed. Sorry, go ahead, Bala.
Madhu is a strange South Indian, but I think with all these investors, especially from abroad, I don't think he sleeps till 3 a.m. So we're giving him the free pass on that. So
right. So good. Look, there are 2-3 questions that I'm going to tell you all at the same time, Madhu, because they essentially relate to your expansion plans, what's next, those types of things, right? So one question is from Gautam, how do you plan to scale 10x from here? What are all the distribution channels that can be leveraged without compromising NPAs? What are your 30 DPD, 60 DPD, 90 DPD on the portfolio? And I'll just tell you the other two also. Then there was, what are you doing? So there are 2 questions here, but the one is about customer trust, but the other is what are your expansion strategies? So what are you thinking about there? And then there is that now that you've built so much scale, you've got marquee investors, you're operating at this level, you're profitable. What next? Is there an IPO? And when is that? So maybe you could take those together.
Sure. I think definitely what's next is always a big question, right? So I think the key thing what we are working today is on diversification, right? So we are trying to diversify products, as in like just to give you kind of some idea. I think we do personal loans, while internally we see personal loans into 14 different categories, but externally it all looks like there's a salaried, self-employed, job profiles, then there are MSME loans and everything. So all these are like largely unsecured digital loans is what we are doing it. I think the one key thing what we are trying to do is get into another loan product, which is into SME loans is what we are getting into. And that is both on the secured and unsecured side of it. Right. So that is the diversification thing on what next immediately what we are talking about. We are also trying to go a little phygital because according to me, after run all these things, other than these unsecured personal loans with the ticket size of less than 1 lakh average, everything else requires a kind of a physical or a phygital element to it. Right. So if somebody says even on a personal loan that keep 4-5 lakh rupees ticket size, I want to do it digital, I would still kind of be worried about that. If someone says that SME loan, I will do it totally digital. Again, there are people who have tried it and they've burnt hands very heavily in that particular line of things. So there is a lot of hindrance in terms of the company to diversify to other products unless one goes a little bit of a phygital in nature. Right. I think this is one of the key things where we are going to enter this SME segment, but also it will be phygital, not totally digital. Right. So the product diversification is the key thing. We have a lot of cross-sell products that we do it. Right. So I think those are gearing up a lot. So we started doing credit score reports is something what we sell on our platform. We do almost about like 15,000 credit score reports, what we sell on a daily basis. Right. So that's what we kind of do that. We started, one of the teams, one of the engineers started saying that, we want to do digital gold. There was a time when this digital gold was was a lot hot. And we just started that, and we were struggling to kind of position that product. I mean, end of the day, KreditBee is known for lending. I mean, this product ko kaise advertise karenge and whatnot, right? So what we see today is like almost like 10,000 transactions on a daily basis. That's on a zero marketing, zero spend, zero burn. Of course, we had this leverage of this customer base, what we have on the platform and whatnot. Right. So we do SaaS APIs also. We kind of sell in the market now. That particular piece of business has generated a PAT of 6 crores for this financial year, for the last financial year, right? So I think that business has come out. So these are what I'm talking about, like some of these adjacent cross-sell or kind of upsell products, what we do apart from the loan products. Now that is where we are today. So what's from here on is we have an anchor product, I would say, which is our digital personal loans. I think that would probably that will be kind of leading our growth for the next few years as well. However, what we are trying to do before hitting that IPO is to kind of have at least not more than 40% of our revenue or 50% of our revenue coming from one single source. Today, that's a higher number from the personal loans. I think we want to have this diversified before we hit the market, and I don't have a larger time, probably 3 to 4 years from here on, we should be there somewhere. And that would be an appropriate time for us to kind of start talking on this IPO and or preparing for the IPO, and then even kind of going in that direction. I think somebody asked about like 30 DPD, 60 DPD. Unless until you are putting $1, I'm not disclosing those numbers. It is.
Okay.
I mean, just to kind of say that, by on or before due date, what we call it, DPD 0, we end up collecting about 88%. That means only 12% is what get bounced off from as a collections bucket, right? So 90 DPD, that goes to about like 96% of collection, from 88 to 96. And by 180 DPD, it goes to 96.5% of the collection efficiency, right? So that is on the static pool. What happens there? Yeah.
Thanks, Madhu. Madhu, what is the sensitivity to interest rates in this segment in terms of NPAs? Like, after the rise in interest rates, was there an increase in delinquencies? This is a question from one of our guests.
Yeah, I think, see, one is basically the interest rates are being increasing at one end for us at the back end, right? So we typically kind of now, keep our interest rate at about like 23%. That is where we operate, which is closer to the microfinance segment at which they are kind of operating, right? So I think 23-24%, we don't have a lot of leeway to go up to like, definitely 23 to 25 is a possibility. But going beyond 25, 26, the quality of customer deteriorates a lot, so in case if you're kind of charging this particular number, right? So I think there is certain push there, definitely. But what has happened for us is because of the equity infusion that happened. I mean, I'm not going to say that, there's no impact or anything, but we were kind of found this equity infusion at a very right time. There's a huge equity infusion happened very recently for us. So, of course, there's a cost to equity, but just from the lending perspective, what happens is this is at a zero cost for us, right? So therefore, there is a way that we kind of always manage it, at a quite leveraged companies wherein, there is a debt leverage has happened heavily on a company. Then whatever the interest rate that is increasing at their end in their borrowing side has to be kind of passed on to the customer. But somewhere because of this, as recent as Jan is when we closed our equity round, and that money has flown in. So we could absorb some of this cost on the interest side because we are lending our own equity money there, right? So therefore, we are not being very aggressive enough in passing that price cost to the customer also, right? So that is how we have managed it. But definitely, that's not a holy grail solution. We were just lucky to be in that particular situation where interest rates are rising and we had this equity infusion. But if you are a leveraged company, I think there's a trouble because it may not lead to an NPA rise. Basically, it will lead to the customers not taking your offers. So your CACs are going to increase. That's what is going to happen. I mean, of course, if somebody is thinking like, I want to keep my growth, so I'll open up the tap and then I'll take whoever accepts this kind of a rate. I think that's where there's a problem with the business fundamentals itself, right? So not having that impact on NPA, but where that impact comes is like CAC, because you're rejecting more customer or customers are rejecting your offers. So that means your acceptance rates have come down and your CACs are kind of little bit growing accordingly, with the interest rate. So the cost is going to kind of definitely have the impact. But our situation was at least for this period, I think the situation is a little better off for us, where we are using our own equity money to kind of lend. So we are absorbing that the interest rate cost.
Yeah. Understood. Well, once again, congratulations on the fundraise as well. One of our guests wants to congratulate you on building an admirable institution. We all want to do that. I think we are totally out of time, so we'll bring this to an end. I'll just make a couple of closing comments, Madhu. Thank you very much. Just for our guests before we conclude, let me just say that the case for investing in venture capital rests on a couple of important ideas. For one, it represents access to private markets, which form a quite substantial part of the economy. A lot of the economy is not in public markets. And beyond that, it represents much higher potential returns relative to traditional asset classes. It has diversification benefits. And of course, it also provides access to innovation, since venture capital providers invest with, new technologies, new business models, disruptive ideas like the ones we've been talking about. So, we as Sanctum believe that this instrument belongs in some allocation in all portfolios of investors who have the requisite size, risk tolerance, time horizon, and understanding. However, it's also important to note that VC investing is high risk. It's a high risk, high reward strategy. Underlying instruments are illiquid. So, even many early stage companies fail even when successful investments, and of course, even when they've been funded well, and even successful investments can take quite a long time to, bear fruition. So we always advise our clients to have a well-diversified portfolio and, to the extent possible, work with experienced venture capital firms. Arkam is, of course, one of those. So this is just our view on positioning in venture capital in general, because that's sort of the subject of the discussion we've been having today. I would like to thank our guests for taking the time to attend this session, to Rahul and Bala, and to Madhu for sharing his story, and Rahul, Bala, for a fascinating discussion. I do hope that our guests have found this insightful. Should anyone wish to spend some time chatting with Rahul or Bala, they can reach out to their relationship managers, and we'll try and find some time. Those questions that we've not been able to answer, we will endeavor to take them off here. There are only a few, and get back to you with those. But for today, Rahul, Bala, Madhu, and Vishnu, thank you very, very much for taking the time, and to all of our guests for taking the time to listen to this.
Thank you. Thank you.
Thanks, Madhu.